This is Satya Pradhuman of Cirrus Research, and welcome to this episode of Market Conversation. It is a replay from our conference call that went through our quarterly outlook. The title of that report was Overhyped Earnings and Speculative Fervor to Spark Volatile Rotational Market. Bottom line, we see very much a rotational market underway, a real broadening that's taking place. Importantly, the speculative measures that we are looking at, they've hit some extremes. On top of that, the earnings environment appears a bit too buoyant. So those are the elements that are driving us to focus on a more defensive outlook. We hope you enjoyed this episode of Market Conversation. Thank you.
The economic backdrop remains mixed. You've got a fading employment backdrop, so unemployment's quietly climbing, and at the same time, you're coming off of sort of 50-year low in unemployment levels. So in the terms of the labor markets, as much as I think there's been a lot of mixed data coming through, the broad picture is that it's generally constructive. The earnings backdrop has been good, even in the thick of the tariff, chaos. This is a very buoyant backdrop, that said. And, even though there's some signs of slowing, what we also have is a central bank that's likely to cut more as we go into the year. In fact, when we look back in the last year, what the market's expecting is for all of the year is about 3 rate cuts. Now, the 3 rate cut expectation jumped. It was really, the expectation for that was like 10% in August. Actually, before August, by late August, it went to almost 50%. And as of today, at this call, what we're seeing is roughly 70% estimate likely for 3 full rate cuts. That means 2 more to come before the year ends. So in terms of how slow the economy is, we have real mixed messages. We've got a pickup in estimates, and at the same time, we've got this, cry for rate cuts. Bottom line, the markets have been downright bubbly. The S&P is up around 35% from the April bottom. The QQQ, they're up about 42% from the bottom. The Russell 2000 is up about 40%. Microcaps, they're up about 56%. Emerging markets up about 40%. And then to close this all off, the sort of commodity that everyone's quoting, gold is up about 35% since the market bottom. Now, if you were to look at year to date, this is a bit shocking. Gold is up about 52% versus the QQQ, which is up about 19% for the year. At the heart of this, there's a lot of changes underway. This market that we're in is very different from the prior 2 years, where it was basically an NVIDIA quote. That's all you needed to do to quote the markets. So before I go into go through the outline and we dig into this, just a slight disclaimer. I was up late last night. The Yankees are in the playoffs, and after last night, they still are. I don't understand why these games start at 8 p.m. After all, it is a school night. And if you're a little bit older, an 8 p.m. start with a baseball game is really tough the next day. All right, so I'll do my best. Let's cut to the chase, though. In terms of the outline for today, I am going to walk through the speculation levels that we're seeing in some of our proprietary models. Bottom line, they're fairly aggressive. 2, earnings expectations. We're sort of scratching our head on what we're seeing here. A massive rebound in forward estimates. It just doesn't square with everything else we're seeing. So what I think this presents is some additional turbulence in the marketplace. After all, high earnings forecast makes it a higher hurdle rate for the reporting season. 3, our asset allocation model, which has been really remarkable. It's been working in the last 5 years plus out of sample, and it's been spot on, incredibly overweight equities. It's finally gone slightly underweight the long-term averages. This is the first time in more than 3 years. So we'll take that seriously. Empirically, markets have been rotational and broadening. So we've been making this case, but if you look back from just the April bottom, from gold, emerging markets to microcaps, and even on the AI front, the downstream AI groups are also outperforming. And then finally, how do we sort of like work in this cycle? How do we generate performance and still protect? Bottom line, we are going to lean the portfolio blends into a quality bias because we think volatility is going to tick higher at this point. And then fundamentally, when we look at things like a term structure, those things create some concern as well for the long bond. So let's jump into it. In terms of the blends, as I said, if on the growth front, I think we have been in more of a GARP territory, which is a little bit more valuation sensitive, chasing strong business expectations. That's what the GARP model represents. At this point, what we'll do for the growth blends, we're going to look more towards a quality growth. In other words, emphasize earnings visibility across the decision tree. On the value front, again, continue to pay up for quality companies is probably the right way to go here. If you now to take a look more fully into the backdrop, the fundamental backdrop, the credit markets are remarkably easy. What we're looking at in the US is that spreads are now about 300 basis points above treasuries. This is basically 30-year lows on credit costs in terms of riskier firms. So at the heart of this, this is one of our favorite gauges in terms of corporate risk. And from what this is saying is that we really do have a fairly good backdrop for firms getting capital. The private markets have been very buoyant. That said, the size of the private market is a drop in the bucket relative to these broader measures. So bottom line, if the broader measure starts to go, that's when we have a real problem. So we're still looking very closely at this. Also, this data is very live and available. In terms of the sort of risk readings that we've been looking at, there are two things that I want to flag here. One is our Cirrus risk score. And in this instance, what we're looking at is the risk appetite model has broken through this upper threshold that we consider to be a period where we want to become much more risk averse, that speculation has run for the last 6-7 months in a fairly aggressive way. And once it crosses this boundary, we really want to now take into account that, hey, it's not just your strategy that's chasing this. This model is saying just about everybody is chasing this market here. And at this point, what we have found is the subsequent 6 and 12-month gains, when these readings, whenever they crossed this one standard deviation threshold, you tend to find below average returns the subsequent 6-12 months. You tend to find, maybe more importantly, trending factors invert. In other words, price momentum factors start to really tumble. And I think that's a big deal when you consider this current market landscape. And conversely, this has been a wonderful trigger to also buy. That at some point, when the markets get most scared, that's probably where you begin to price. The market's probably priced in the fundamental concerns at bay. So at this juncture, this is a pretty critical reading because in the last year or two, as many have claimed that the markets were too speculative, this model has actually been fine. It was clearly climbing, but finally, as of last month, it broke through this upper threshold. In terms of some raw numbers, I think the momentum factors, the last time we got this sort of a trigger moment was August of 20. The momentum factors broke down by about 19% 6 months later and 21% 12 months later. So bottom line, when the risk measures are this extreme, we do really become much, much more concerned. Secondly, the crowding model, which we've made a big deal of, this model finally did strike into this concerned upper territory. This year's been super interesting for crowding. Our model last year going into the start of this year basically had been benign until January of this year. That then led into this pullback that we saw with the tariff announcements. The sell-off allowed the sort of crowding measure to sort of settle. And then the last 3-4 months, this model has now spiked back to some historic levels. So at the heart of this, what we are empirically showing is that investors are very crowded into the sort of AI verticals and all the subcomponents I think there are. One of the bright spots in this is that, unlike the last 2 years, what we can now show is the downstream AI groups are benefiting from the spending. And as a result, the AI risk that was firmly lodged maybe in a handful of firms has certainly broadened out across several categories from cybersecurity to data centers, et cetera. So moral story, though, is that when I bring these two models together, what I'm looking at, if you look at our sort of risk clock here, the upper boundary of this clock, the noon level or the midnight level, that would represent extreme optimism, right? And in both instances, our risk appetite in the US and the crowding model in the US are now at that sort of midnight level. What does it mean when these models are there? Collectively, what it's really meaning is that leadership comes under pressure. Momentum factors start to break down, and value and quality factors start to offer some protection. It's easy to say that value and quality will outperform. In reality, though, that these are usually systemic breaks. And if you get a broader market pullback, nobody wins, but lower multiples tend to save the day. Higher earnings visibility tends to hold up better in a very noisy, turbulent market. So that's sort of like the tactical elements that that we're seeing here. In terms of the last time both of these signals triggered at this level, if you go back to August of 2020, the subsequent year, large cap momentum was down about 21%. That's like by the summer of 21. In fact, large value in that same window was up 4%. So yes, it massively outperformed, but you're talking about much lower absolute rate returns. And then very similar results in the smaller cap models as well, not as dramatic. The momentum factors did not break down anywhere near as much. And the value factors really, really ran. If you recall, that 21 period was really a period of the reopening per se, airlines, casinos, and what have you. Most of those gains showed up in the smaller cap arena. So bottom line, though, we are in a very unusual territory. And I've got to, really stress that, the best way to sort of buy into this marketplace to stay equity centric, but yet offer some protection is to begin to look at where your multiples are getting stretched, where the business momentum is starting to get soft. If it's not accelerating, that could be a problem in this window. Now, these models don't necessarily trigger a reason for markets to break down, but what they're saying is that any adverse news with these readings, the market will take the impact more dramatically. So in other words, all of the sort of fallout information becomes amplified when you're in these zones. And I think that's a good way to think about it. It's not that people will see these readings and say, oh my goodness, I have to sell. So I just want to make sure that we get what we're saying here. To tie this back together, though, because some of those variables fit into overall asset allocation models, what our model is showing is that it has been incredibly overweight equities the last few years, and correct. But what we're now seeing is that it is quietly fading. It's fallen below the long term. The 30-year average between the stock bond allocation in this model has been around 49%. So the fact that as of last month, this model is now at a 47 handle, not the end of the world, but it's got some meaningful triggers, because the last time it broke below 49, this goes back to January 22, the market was down about 12% 12 months later. So we're taking this seriously. And so what it is saying is that maybe we brace for a bit more volatility. Maybe it's a lower absolute return markets. That said, corporate profits are okay. We'll get to that in a bit in terms of where the froth is, but corporate profits are okay. Okay, labor is okay, and you've got a very easy Fed likely in the wings here. So it's hard to say that this is not a good time to own risk assets. It's just that it's a very crowded game. So some of these elements that I've just walked through, they are more tactical and technical in ways. More fundamentally, though, what's kind of driving this issue? And this is where we get into the bond markets. And when you look at the term structure, it's incredibly steep. The yield curve has moved drastically different from just a 9, 12 months ago. So what we're saying is that in the face of a slowdown, as the Fed is likely to cut rates further, this is uncanny to see a yield curve that's still steep. And the reason I bring this up is that long duration assets will really get valued on the longer side of the bond market. So if you have the 10 years remaining high or accelerating higher, that is awful news for long duration equity bets. So what this is saying is that the market is nowhere comfortable with this current moment and the likelihood of a rate cut. In fact, in the 30 plus years we've looked at this data, I've looked at this data more professionally. What's interesting is this is the first time we're seeing multiple chances of multiple rate cuts where the yield curve, the term structure is steep. Usually it's inverted, that the bond markets are dictating to the central bank that it needs to cut rates. But in this case, it's very different. So this is the stuff that creates this sort of backdrop that says, hey, this is a rotational market. Forget about the tactical stuff for a second, but this is the stuff that longer term investors have to be thinking about. And ultimately, how do you deal with a term structure that's steep and with the potential of a steeper yield curve? So how could we get to a steeper yield curve? Well, coming off the pandemic, you've got the inflation bogey that's not gone away. The nearshoring that's been from the last administration, amplified by this administration, those things are generally inflationary in nature. So there's plenty of reasons to see why the term structure is represented the way it is. But what does it really mean for the equity investor? The bottom line is that if the term structure backs up further, and now that risk becomes increasing if you're cutting the short end, right? Because if the bond market investors do not believe there's a reason to be cutting rates and the Fed cuts rates, it could in fact cause the term structure to invert further. So, or steepen further. So moral of the story is that what this does mean is valuations are going to play a role. This is a factor that has not been spoken about. It's not been in any of our titles in the last couple of years, and for good reason. But if you look at where we are today, whether you look at the US markets with large caps versus mid and small caps, what you're looking at is historic 30-year wide spreads in valuation. So this is important. If the term structure is not behaving, if inflationary concerns are surfacing, what does that really mean? Why would valuations matter? Well, if inflation picks up, the margin assumptions we're making are going to get turned on its head. So if we're looking at the large cap proxies right now, you're looking at historically high margins, and some of the bulls in the room will say those margins are here forever because we've got AI and the margins are just going to get better and better. We could get there, but it doesn't mean it has to be a straight line. So moral of the story is that valuations will pick up, will, as a factor, matter more. Investors will pay more attention to that if inflationary concerns remain, if the term structure remains in the fashion it is. Globally, we're also seeing the same thing. In the last 20 years or so, the US multiples have really become much more extreme and really benefited from maybe smart management at the central bank versus the other markets, or maybe all the sort of fundamental factors going on. But bottom line, you're looking at historic breaks with the US equity market and the rest of the planet. These are things that are sending a very, very strong signal here that says, hey, a lot of perfection is priced into US equities. And so at the end of the day, investors are looking high and low for additional opportunities. So bottom line, though, empirically, this market is already broadening. If you look at the quotes I gave earlier in bar chart form, what this is saying is the market's up from the April bottom, 33%, 34% roughly. Russell's up 38%. Microcaps are up 53%. Gold is up 30%, and emerging markets are matching the US markets. Bottom line, asset allocators globally are going through the same thought process. So we do have a frothy market. I think most everyone now agrees that AI is not just um, a speculative bubble in the making. In fact, the first 2 years of this run, when investors just bought the chips, that's pretty much what they were saying is, hey, we don't know if this is real, but we'll buy the chips because they seem to be the place to go to. Today, firms are embracing this. And so what we're also seeing is a broadening through the AI channel. Now, at Cirrus, we launched the downstream AI bins last year and actually rescaled it to more finer details this year. This is a wonderful dashboard to recognize that, hey, we understand since the start of the year, semis are up 25%. This is the AI more centric semis, not the entire semi sector with Intel and the rest. We're trying to really carve out the AI players. The second path is really the downstream plays, which is broken up into two factions. AI infrastructure, which holds like big data, data centers, alternate energy, nuclear is one sampling, and then applications from consulting, cybersecurity, etc. Moral of the story is that the AI thesis is broadening. And so investors already have found other ways to benefit on AI instead of just owning NVIDIA. And that's a good thing. In other words, that's what's allowed, I think, this market to remain more resilient this year. If we were all just looking at the chips, I think there would be a much bigger problem. But the fact is, this industry is real. The subsectors are very real. And in fact, in terms of where spending is going, the opportunity to bid up these other verticals are terribly important. One additional factor that we've really done, I think, a decent job underscoring is the fact that the industrial sector is a very strong part of this AI thesis. And it's in fact in the industrial sector is actually outperforming the large cap tech sector year to date. Last I looked, now they've been sort of neck and neck for a while. But what that's telling us is that, effectively, we think that the plumbing for AI is the power generation industrial story. And that's why the stuff is working. If you look at alternate energy like nuclear, it's up about 38% for the year. If you look at data centers, it's almost 30%, and cybersecurity about 29, 30% as well. So all of these other pieces begin to really matter the more the industry sees AI opportunities being put to work. And so this broadening, I think, is happening. One of the side effects is that what you've got here are really a valuation sort of threshold that's opening. Shifting gears, this was something that really, really caught us off guard. Here we were thinking about the tariffs and the potential hit to margins and therefore the risk to earnings. And along comes this window of where the market and investors have looked through the tariff risk. But what's interesting, though, is that if you look at the smaller cap market, the forward year estimates, they're roughly 6 out of 10 estimates are getting raised higher. That's incredibly powerful. In fact, if you go across to the larger cap comps, you're now at a 70% plus handle. That's very dramatic. It's very unusual. In fact, this is more than 2 standard deviations above normal. So moral of the story is that the forward estimates have become incredibly bubbly as we're going into this earnings season. And so with the, in the wings, the chance that the central banks are cutting rates potentially 2 more times this year, and you've got really aggressive forecasts, it'll be interesting to see how this plays out because what you've done is raise the hurdle rate for earnings reports. So, I think this is a window where we really got to consider how do you play defense with this earnings season. One important chart to flag, and this one's hard to read, but I'll do my best to flag it because I think it's a big deal. The moment we saw the forward estimates pick up, we're like, hey, this is all AI. It's got to be. But what's really important is you segment that data one sector at a time. Guess what? The delta in staples reversed. the delta in financials are massive, which we like. We think this type of backdrop with a regulatory backdrop that's going to get easier and easier, we think financials really, really win the day. Two, some of the elements in the recent budget bill, they are sort of chock full of supports for industrial spending. And as a result, we think the financials make a lot of sense. So the delta on the financials have been dramatic. Notice that both those sectors, what you're seeing is that it's north of 2 standard deviations above normal. The large cap universes as well. Notice healthcare is almost 2% above, 2 standard deviations above normal. And slightly below that is technology. In other words, it's still very buoyant, but there are 3 other sectors that have much more aggressive forecasts in a window that the central bank sees that, hey, there's enough softening out there that we really need to cut rates. So bottom line, though, is that you do have yourself a very mixed batch as you're going into the earnings season. And this leads to our usual work that we do in terms of playing protection, the earnings torpedo models. In other words, let's now go at the bottoms up level to flag those firms where the forward estimates have become so extreme, they're at the very upper end. And at the same time, the variability in those forwards are incredibly tight. In other words, let's find those firms where not only does the sell side love them, but they're also sure. So that is a backdrop that I think as we go in through the earnings season, these types of models become more and more important. Just a couple of final points here in terms of active management results. We've talked a lot about this, about the active pain in large cap growth, notably how large growth managers have really challenged. If we're right about this market broadening, like micro caps matter, small caps matter, emerging markets matter, as that's occurring, what this is saying is that that sort of performance pain that large cap managers have endured, they may be getting easier as we get into the fourth quarter, into the first quarter of next year. This is, I'm sure a lot of large cap managers would love to see this play out. But at the heart of what we're saying is that the math of it is that if you get a broadening, the sort of diversified portfolios start to outperform, full stop. Equal weighted S&P beats market weighted S&P. Two, short books start to matter again. If valuations matter, then our short blends outperform. So these things are all tied at the hips. So if we're right about some of these assumptions about there's a chance for a broadening here, the fundamentals in terms of the yield curve, inflation, those things are telling you that valuation should matter more. We are looking at a place where large growth managers get a breather. And so for those managers that have been hiding under the AI bin without doing the fundamental work, I think we are going to see some problem performance in some of the winners out there. So that is something that we're going to watch. Part two, the small cap, mid cap world did not have NVIDIA in its benchmark, and some of our active blends have done well. The problem here is that if we're seeing micro caps perform well, this is a real painful period for the active small cap manager. After all, the active small cap manager needs liquidity to run the strategies very well. And what this is saying is that if you get smaller, less liquid stocks that perform, the relative performance for small cap managers begin to really struggle. So this is something that we're sort of bracing for. I think it does come hand in hand with a broader market, that if large caps, if small caps are outperforming large, equal weight beats market weight in the S&P 500, and in small cap land, micro caps beat small cap. So that is something that we call the domino principle, and that's playing out. And so moral of the story is that you do have yourself a real change here that's building. Really hard to sort of see through this because there's such sort of conflicting signals. But I do think that the sort of bigger picture is telling us to become a bit more cautious, play a little bit more defense, save some of the dry powder for another day. So in terms of pulling this all together, what we're saying is that the speculation runs, they're high as risk appetites climb they're well above normal. Our crowding models are really flashing red. So it is really a buyer beware posture. What sort of amplifies this concern is that the earnings expectations are now fairly aggressive. I've got to say, this is a data point that should probably throw a curveball into the Fed perspective, but at least from the betting markets, it does not seem like it matters. And then the asset allocation model is saying, is really backing up what we're thinking here in terms of becoming more conservative. I think, though, that when credit is as easy as it is, it doesn't make sense to avoid risk assets. It's just that we could be in a very rotational market. Empirically, we've been able to show that, hey, this has already been occurring since the market bottom. And if we're right, as the sort of upper end gets more stretched, this rotation becomes more dramatic, not less, as we close this year and as we go into next year. So at the heart of this, we are leaning into our quality blends a bit more. We think volatility will tick higher using defensive models like torpedo models. Those are good things in a place where the earnings estimates are ramped up, maybe too high. And so that does it. In terms of any questions, do feel free to follow up with us. Happy to take them, and we'll get right back to you. Thank you.